Good day, everyone. My name is Denise Appleby, and this is another episode of IRA Conversations with Appleby. My guest here today, I will allow them to introduce themselves. Louis, Hi, Emily. So great to have you.
Great to be here.
Ladies first, Emily, a quick intro.
Yep, my name is Emily Bowler. I am the relationship manager for the CapSouth office in McDonough. And I've been with the firm a little over 3 years now. And my primary role, I serve to try and keep the team focused, keep our clients focused, so that we can accomplish everything that needs to get done.
Nice. Louis.
My name is Louis Robinson, of course. I'm a managing director of the McDonough office, senior wealth manager. Retired CPA in 2011 and joined CapSouth at that time. And because, as you know, after I've told you many times, you retire to something and not from something. And this is my to, and my from was the CPA practice. And this is much more enjoyable than a stack of tax returns, I can tell you that.
That's right. And I've been using that ever since. And of course, my name is Denise Appleby, CEO of Appleby Retirement Consulting. My clients are financial, tax, and legal professionals, and I help them help their clients keep their IRAs out of trouble. And I also created and own retirementdictionary.com, a free consumer website. And today we're here to talk about IRS Form 8606, and you have a link to that form in the comment section. Why are we talking about Form 8606? Because the Form 8606 is the IRA owner's friend. Here's why. When you have a 401k, there's a plan administrator that is responsible for that, and that plan administrator tracks the basis, which is the after-tax amounts. When it comes to IRA, the IRA owner is the plan administrator, and they're responsible for keeping track of basis, and this is done with IRS Form 8606, and if they work with a tax preparer, the tax preparer should file that form. And so the question becomes, what happens if the form is not filed, right, Louis?
Yes, and that happens.
Yeah.
And because you're going to need that basis at some point in time, and if you don't have that 8606 file, then it's going to be pretty hard to determine what the basis is.
Exactly. And so the question becomes, where really does basis come from? Basis comes from two places: a non-deductible IRA contribution and rollover of after-tax amounts from, say, a 401k or 403b account to a traditional IRA. You get basis in a 401k if you make after-tax contributions, for instance. And when you roll over those amounts to the IRA, a subsequent distribution or conversion of that amount is tax-free. But a lot of people are paying taxes on these tax-free amounts, the rollover of after-tax and the non-deductible contribution, because they didn't file Form 8606. Any comment on that?
I'm going to give you an illustration. I think the best way to show why it's important. As a CPA, I had a client who's since passed away, and this has been many years ago as a CPA client. I know as his CPA that he made a lot of non-deductible IRA contributions. Well, after I retired and joined CapSouth, he passed away, and his wife came to me to help her with the investments. And I knew they had a tax basis in some of those IRAs, but we didn't have any records of it. I contacted their current CPA, and he didn't have a record of it. So I know she's got an IRA now that's been transferred to her, and there's basis, and we don't have a clue as to what it is.
That's such a terrible scenario to be in. And so the question becomes, what do you do in that case? Because you don't want to have her paying income taxes on amounts that should be tax-free. And so the challenge for you operating as a CPA, what do you do? Or whoever a CPA is, you got to go back and recreate the basis. And this is accomplished by reviewing the tax returns for every year, Form 5498, to see if any contributions were made to an IRA, and comparing that with the tax return to see if what's reported on the form, if it's 498, was deducted on the tax return. And if it wasn't, then we know Form 8606 is missing, and that should be filed. Now, that's a very onerous task. A lot of people don't want to do it, but there's a recent tax court ruling. If you Google my name, it's called Cohen Rule, where the tax court allowed an individual to use other methods to go back and find out where the basis is and recreated it. And he was able to provide a satisfactory set of documentations and proof to the tax court. And they said, this is acceptable. You can use the Cohen Rule to create your basis.
But, sometimes coming up with those estimates or whatever, like in this case, it's probably been 20 years ago. It's been a long time ago.
Yeah.
And coming up within those records, I've called the CPA, I've called the investment firm that used to do that. Investment firm or the advisor, he didn't even remember it.
They don't know because they're not required to keep track of the basis. The IRS is clear about that. The IRA custodian does not track the basis. They're not required to, and they don't. But I see Emily. I know you have a question. What's your question?
Yeah, in talking about this form with Lewis, I was intrigued as to why someone would even make a non-deductible contribution to begin with.
Such a great question. Now, one of the reasons why we save in IRAs is to help fund our retirement nest egg. And when you make a contribution to a Roth IRA, you're able to do so only if your modified adjusted gross income is under a certain amount. And so the question becomes, if you cannot make a contribution to a Roth IRA, can you make it to a traditional IRA then and help feather your retirement nest egg? And the answer is yes, because there's no income cap on contributions made to a traditional IRA. But the challenge is, if you are covered under a retirement plan at work or married to someone who is, you might not be able to claim a deduction for that contribution. Because then you're considered an active participant. If you go to my dictionary, retirementdictionary.com, I explain what active participant means. And so the question becomes, Emily, you cannot make claim a deduction for the contribution. Should that prevent you from adding $6,000 to your retirement nest egg? And some people say no. So they still make that contribution, file form 8606, and guess what? You can eventually convert that amount to your Roth IRA. That's called a backdoor Roth IRA contribution. And if you have no other assets in any traditional SEPs or simple, then that conversion will be entirely tax-free. But if you have pre-tax assets in any traditional SEP or simple IRA, then the converted amount includes a prorated amount of your pre-tax and after-tax balance. That's an excellent question.
Let me comment on that. After she asked me that, I started thinking about the particular case, particular client. And the reason he did that is because he participated in a plan where he worked, and also he was
active participant
in two different plans. So he could not make a contribution to the IRA. So he made a non-deductible. But now I'm thinking in retrospect, was that very smart? Because if he'd put that same dollar amount into what we call a retail account or a taxable account, then most of the income, like dividends, would be subject to capital gains. Also, right now, that's in his IRA. You don't get a stepped-up basis. If he'd put it in that retail account, he'd have a stepped-up basis, and then we wouldn't even have to worry about keeping up with this basis. So I'm trying to wonder, why in the world would you want to make a non-deductible? I understand you make a non-deductible so you can do a backdoor Roth. We do those all the time, but we do that immediately. We don't carry it forward for several years. We do it the year we make the backdoor IRA contribution. So yeah. I just think you're asking for a lot of problems when you make these non-deductible contributions to IRA or 401k, either one. Particularly when you probably not going to keep up with the basis.
Yeah, it's a valid question, but I think a lot of people, their position is the compound effect of growth upon growth for tax deferred earnings is very powerful. But I think that's a valid point, which is why we agree, all of us, that when it comes to any retirement planning or financial or tax planning solution, there's no one size fit all, which is why an individual should have a team of a financial advisor, a tax advisor, and legal advisor, depending who's going to look at their particular scenario and say, okay, you want to make a contribution of $7,000. Should you make it to a Roth, a traditional, or a regular account? And when you're dealing with high net worth client, it's a different answer than when you're dealing with people who are not high net worth, because for them, it's easy to just put the money in a traditional account where they don't have to track basis, and all of that stuff gets complicated for people who don't have a lot of money to hire professionals like you. So there are different reasons, but I do see your point.
Yeah, like I say, in retrospect to this one, that'd have been a lot better because we wouldn't be paying tax on something we shouldn't, which is what we're doing right now.
Yeah. So Emily, I know sometimes you help clients when they come in to make IRA contributions. Any comments, advice, things that you've seen?
One thing that I will note is that if you're making, the IRA contributions or the Roth conversions or qualified charitable distributions, you got to make sure you give all that information to your CPA correctly and make sure that they include it correctly on your tax return to make sure that you get any deductions that you deserve.
Oh man, that is such an excellent point, because when I have conversations with CPAs, when I do classes and I teach them about this stuff, they're like, what are you talking about? My clients don't tell me about that. And that's because they don't have people like you, Emily, because part of what you do is to make sure that all the dots are connected. And that includes letting clients know that you got to let your CPA know that you made a contribution, because guess what? The Form 5498 for that contribution is not going to be issued until May of the following year, when your tax return has likely already been filed. And your 5498 is not required to be attached to your tax return, so you don't feel like you need to provide it to your accountant. So that, I think what you just said is probably one of the most valuable piece of advice that's going to come out of today's session. You got to communicate with your tax advisor and let them know everything that you do so that they can track your basis and everything else that's relating to your retirement account transactions.
We just had a case this week, in fact, where a client made a Roth contribution in the first part of 2020. And then the latter part of 2020, he sold some rental property. His income went over the 208, so he couldn't make it. But when he went to take his tax return in, they did not ask if you did a Roth contribution. And they may have had a list of questions, which most organizers have probably 200 or 300 questions on it. And I'm sure the client didn't see it if it was there. But bottom line, we called it, or Emily actually called it when we were getting ready for a review with the client, is he made a Roth. I said, well, he can't make a Roth because his income's too high. So we had to have it reversed. And fortunately, we found it before October 15th. So, and that's the problem. People are not just communicating, and they're dropping stuff off to the CPA and run.
Yeah. It's so important, because if you hadn't caught that, the question becomes, what happens? You have an individual who makes a contribution to a Roth IRA. They're not eligible to make that contribution. They don't tell their CPA, so the CPA doesn't know to run it in the accounting software. That's going to pick it up to say, you're not eligible for this contribution. What happens then? It creates an excess contribution that stays in the Roth IRA. If it's not corrected by tax filing due date plus extension, it's subject to a 6% excise tax for every year it remains in the account. That's a very, very steep penalty. And that's one of the reasons why I like to tell consumers, talk to financial advisors who understand IRAs, because there are a lot of brilliant people working in this field. But when it comes to IRAs, you got to be IRA smart to pick up on stuff that you and Emily pick up on, you know? So you got to interview your advisor and ask them, most of my funds are in my IRA or 401k. How much do you know about this stuff? And the advisor has to know enough, not to say that they have to be able to give the responses off the cuff, but know enough to say, wait, I need to double check this, or I need to ask more questions and get more information about so that you guide the client correctly. Do you agree, Emily?
Oh, yeah. We're very thankful for your connection, for us to ask questions when things come up, because they do often.
Exactly.
One of the things I tell our staff and told accountants who work with me before, if you know what you don't know and you know where to get an answer, you don't have a problem. But a lot of people don't know what they don't know, and so they don't even try to get an answer. If I find something I don't know, I call Denise to get an answer. So you got to be willing, you got to be able to do both. Recognize it and then find an answer.
I agree. And I think for you too, from what I know, because I've been in calls with you where you're talking to the client, you have to know the right questions to ask. For instance, if a client says, I've been making a contribution to my Roth IRA every year. I checked it 5 years ago and everything was fine. So now every year I put in more amount. And your approach would be, okay, you were qualified 5 years ago. Let's review your income now to see if anything has changed. And what's your tax filing status? Married filing jointly, married filing separately, single? Questions like that to get to the heart of what the correct response is or what the proper advice is to give the client. So that's one of the things I appreciate about how you and Emily respond to your clients when they bring these questions to you. It's to ask more questions to get the right answer so you can advise the client properly.
I'd like for Emily just tell you the process that we use and why we find this out a lot.
Yeah. Good job, Emily.
You're talking about tax returns, Louis?
Yeah, yes.
Yeah, so we always request clients' tax returns. We even, a lot of times clients don't like to have to get a digital copy and send it to us. So we create a release form that we have clients sign, and then annually I can just request it directly from the CPA. And it's really helpful. They send it through ShareFile for us to access. And then Louis will review it. And we also have a holistic plan software that's a tax software that we put the returns into. And he's able to quickly see, we did a Roth conversion last year. Why is that not showing up on here? Or you made QCDs. How come all of your IRA distributions are showing up as taxable? And so a lot of the times we have to help our clients get amended tax returns to make sure, like I mentioned before, that they're getting the credit, the taxable credit.
Perfect. And you mentioned QCDs a couple of times. So I have to just quickly mention what that is. And one of our future episodes is going to cover QCDs, but it stands for Qualified Charitable Distributions. And it's a provision under the tax code that allows any IRA owner who's at least age 70 and a half on the day that the distribution is done to treat up to $100,000 as a tax-free donation to an eligible charity. There are certain requirements that must be met, and we're going to be talking about those, as I said. But I'm so glad you brought that up, Emily, because it's coming on to R&B season, and sometimes that goes hand in hand with QCDs. And I'm so glad you're helping clients with that, because the guidelines from the IRS says the custodian must report those as a regular distribution. And so the challenge for the CPA is, how do I show this on the tax return as a non-taxable distribution when the 1099-R is saying otherwise? So thank you for doing that for your clients, and thank you for raising that issue here. It's very important.
We actually provide them with a list of all the QCDs that they did make to whichever charities, and we tell them, please give this to your CPA. It's a list of all of them that they've made, and we have another team member, Angie. She spends a lot of time putting that together for them.
Yeah, and you know why that's important, keeping that list? Because sometimes they send the checks to the charity, and the charities don't cash the checks. And so how do you know whether or not a QCD has been processed? You use the list that you provide, you compare it with your IRA activity, and you'll say, oh, ABC Charity didn't send in their check yet. So let me call them and see what's happening. You guys have a well-oiled machine here. It's good.
And we've had several where they didn't cash a check. I think the charity thought it was a junk mail or something, because I think there's one, there's two or three that they didn't cash, and we finally got it straightened out. In fact, Schwab started requesting all the QCD checks be mailed directly to the client, and the client physically give it to the charity. Apparently, they were having problems with charities cashing.
And if they're doing a regular distribution from their IRA as a QCD, then it's not so much of an issue for the client because it still counts as a distribution for that year. But you do have some IRAs with check writing capability. And if you write a check and give it to the charity and they don't cash it by the end of the year, then it does not count as a distribution for that year. Right. And if you intended to have that cover your RMD, then your RMD would not have been satisfied. So then we would have a problem with that.
Yeah, we always encourage a client, if you're going to write a check, write it early.
Yeah, I agree. Well, this was great. So much that we could dig into and so much good information here. Louis and Emily, any last comments before we wrap up?
Well, I said we could do a topic on the QCDs. There's a lot of different areas where there's, people just don't know or don't see.
Yeah. And what I like what Emily stresses is about reporting the transactions on the tax return. So Emily, either that, or do you have any ideas for any other topics?
Along the lines with QCDs, we could talk about donor advised funds as well, but.
Yeah, excellent. Thank you guys. This was great. We could be here for hours.
Yes, we could.
Yes, we could. But we like to break them down into bite-sized pieces because these topics get so complicated. It's good to put them in small sessions so people can understand that information, focus just on that, and then move on to the next topic the next time. So thank you. This has been another session of IRA Conversations with Appleby. Thank you for joining us, and please keep your eyes peeled on this section. We're going to be including the website and social media handle for all of us here. So if you want to follow us for important information. Thank you again for joining us, and see you soon.